we do aggressively time the markets if need be. The rest of the time, and that's critical, your by default position, unless you have reasons to believe otherwise, is to be invested in the market.
One of the things that we also talk about at Julius Baer is time in the market, not time in the market. But you did successfully spot a potential crash and you exited various positions in advance. What was it that you saw back then?
The nature of equity market downturn varies across cycle. The driver, the reason why the market is tanking is different. So if we make a comparison here between 2022 and 2008, in my playbook, 2008 was much less difficult to read and navigate as compared with 22. Here is why. In 22, the market is driven by an unexpected surge in inflation in Western economies. This is, of course, endogenous to the real economy, but it's extremely hard to assess by how much, first of all, inflation will increase and for how long. You can have a view on what are the driver of that inflation spike, but again, assessing the length and magnitude of the spike is very difficult. In addition, you have to take into account the policy response, nowadays not just from the central bank, but as well from governments with the return of fiscal supremacy in macro policy making. So this is extremely difficult to calibrate, to assess. In 2008, you have a systemic crisis that eventually led to a recession. A systemic crisis transpires in credit markets. So the balance sheet of the entities that are affected by the systemic problem experience a relentless increase in funding costs. Credit spreads widen. So the credit market is giving you the pulse of the crisis in real time. The one thing you know in such circumstances is that to end the crisis and turn things around, you need an adequate policy intervention in size and nature. We got this finally in March, April of 2009 when QE and TARP were announced by US authorities. We knew this was the turning point. And we knew that until then, every rally in the market was just a counter-trend bear rally. So the crisis was far more severe in a way than 22, but actually, I would argue strongly, much more difficult to navigate in 22 compared with 2008.
Was seeing that and exiting back in 2008, do you think that was potentially your biggest success? What has been your biggest success as a money manager?
My best year was 2011. In 2011, the US was still in the balance sheet recession in the aftermath of the asset price decline of the crisis of 2008. I mentioned the policy response, which was adequate in spring of 2009. Part of that policy response critically was quantitative easing, implemented under the leadership of Ben Bernanke at the Fed at the time. And actually in June of 11, the Fed announced that they would end QE. And we had at the time a very strong conviction, very strong view that this was completely premature to end QE, and therefore deflationary forces that result from a balance sheet recession context would reassert themselves pretty quick. They did in an extremely harsh manner over the course of the summer. And so we reduced risk-on assets going into the summer. We bought bonds and treasuries. We were at the time invested in gold. All of those assets perform. We took the profit in October, went back long risk assets. So I would say in terms of excess return relative to the markets or relative to our direct peers and competitors, 2011 was by far my best year.
Just going back to this idea of success and failure, or success and less success, is the time and timing the market. It's what we mentioned earlier. It's very easy for investors to leave the market, to exit, but it's very, very difficult for them to get back in. That's the hardest part, and this is really where, this kind of investment process comes to the fore.
Yes. Well, look, Just anecdotal evidence to begin with. I've been chief investment officer of leading investment organization for 25 years. And you can imagine in those capacities how many portfolio I've seen in my career. I've seen nobody producing above average return on a repeatable manner, recurring manner, by actively timing the market. The problem with timing the market, it's a binary decision. Therefore, it's extremely difficult to diversify that decision. A solid portfolio as a portfolio of bets embedded into it, not just one bullet. If you miss the target with market timing, you're in trouble. Look no farther than 2023. You miss January, November, your year is miserable, So in 23, there were really 2 months where you could not afford not to be in the market. The rest of the time, you could take a sabbatical, right? The problem is that's not how it works. In investing, you don't take the good days or the good month and leave the bad ones to everybody else. It's not a reliable source of alpha. And we do aggressively time the markets if need be. We mentioned 2008. I also explained 2011. But these are rare circumstances, once or twice a decade. The rest of the time, and that's critical, your by default position, unless you have reasons to believe otherwise, is to be invested in the market.